Well, good afternoon. We know that we are the wrap up for you this afternoon, but I think that this conversation will serve to really tie up in a bow some of the things we've talked about throughout the day. I think that you're going to hear from this esteemed group of colleagues some views, high level, on the PE flow market that we're seeing in 2025 and what we think we'll see in 2026. And then we're going to get into some granularity around trends and actual deal flow, and some of the diligence items that we're seeing, et cetera. So we'll talk to them about challenges and opportunities that we see with those trends. So, gentlemen, I would like to ask you if you wouldn't mind introducing yourselves quickly, just your name and where you're from and what you do, just for context.
All right, so I guess I go first. All right. Jonathan Jasinski, I'm a partner at Harder Seacrest and Emery based in our Buffalo office. My practice primarily revolves around M&A, both representing PE-backed platform companies as well as folks selling to PE.
Kevin Bodner with Witham. I lead Witham's investment banking practice. Our focus is in family founder-owned, middle market, lower middle market businesses.
Sean Moskal, I'm the commercial banking market leader here in Buffalo. Our practice focuses on family-founded businesses, public companies, kind of everything from 10 million in revenue up to multi-billion. Certainly includes a lot of private equity-owned businesses.
Hi, everyone. My name is Mike Panisha. I'm a vice president at Argosy Private Equity. Argosy is a lower middle market private equity firm based outside of Philadelphia, Pennsylvania, and I work on the investment team at Argosy. We invest in specialty manufacturing and business service companies that are between $3 to $10 million of EBITDA.
Great, thanks. So, Mike, let's actually start with you, and then so I think we'll start with Mike, and then Kevin, maybe if you could handle this question as well. If you could just give us an overview, high level, what trends you're seeing in 25, what you think we're heading into in 26 in terms of activity, deal volumes.
Yeah, sure. I could jump in with that one. So I actually sat on a similar panel earlier this year, talking about how everyone at the start of 2025 thought that this was finally going to be the year where we saw deal volumes pick up and the market really open up. And so when you think back to the last handful of years, there's always been a story. Obviously, in 2020, we had COVID. 2021, we had a lot of inflation. A lot of deals got done in 2020 and 2021. But there have been challenges since then. 22, rising interest rates, Russia, Ukraine. 23, we had the Silicon Valley Bank crisis. 24, we had an election year. There's been a lot of reasons for people to sit on the sidelines over the past few years, and everybody thought 2025 was finally the time, once we got through the election, that things would open back up. And we haven't really seen that materialize, I think, in large part due to the tariff activity that's going on. I think a lot of investors and a lot of companies are being cautious in transacting and want to find the right opportunities. So we have seen certain industries, especially companies within industries that are not very exposed to tariffs, have higher volumes. But if you zoom out and look at the overall deal volume for 2025, deal count, transaction counts are down. Dollar volumes are up, largely because of the large end of the market. There's been a lot of take privates and other larger deals that have occurred, but the market hasn't really boomed as much as we thought it would in 25. I think people are back now to the view in 26 that 26 is finally the year, but we'll see about that.
Yeah, I'll just add to that. I'm glad you remembered why everything stalled in 22, 23, 24, because I wouldn't have been able to come up with what the exact reasons were. But yeah, a lot of false starts over those couple years on a volume basis. I started 25 thinking, just like everybody else, it would be a banner year, and starting panicking about how am I going to execute from what things we had in our pipeline. And then came Liberation Day, and things changed, and everything kind of ground to a halt. Rates stayed high, stubbornly high. People got kind of antsy about where the market was going, where the economy was going, and things really stalled for a while there. I will say, anecdotally, in my practice, we're seeing a big uptick again in the last 8 weeks of pitch activity. Owners that I have spoken with a year ago now are calling back and want to start getting in front of them again and talking about conversations. We got a bunch of things now that are really percolating, going well. So it's kind of the same old story, but I think 26 is going to be really good. But it has, the interest rates have really started coming down. The activity again has picked up. Again, you're talking about the tire side, or you're right on. Most of the activity, if not all my activity, is more service related businesses as opposed to manufacturing, making something. So there are pockets out there that are good. I'd say in 25, the activity has been a lot of kind of tuck-in activity, strategic, smaller, bite-sized, smaller transactions. Averages and valuation are down, but that's again because of the smaller, less quality in there. But the businesses, the premier kind of assets that have scale and quality, we're getting premium pricing, and there is a premium kind of price that's being paid right now in the market for those better deals.
Yeah, thank you. So you guys have hit on tariffs and heard a little bit about rates, and we talked about some of those things throughout the day. But if I could send it over to Sean and Jonathan, other uncertainties like these, what are you guys seeing this year? What are you kind of projecting as you look into 26?
About what's getting done.
Yeah, just and around some of the uncertainties we've already talked about, whether it's tariffs, rates, etc.
Sure. So part of me wants to channel my inner Josh Allen and distribute the ball and pass to my panelists to see what they think. That's because I think banks are getting squeezed out of a lot of these transactions with kind of the rise of private credit. But I thought that answer was a little bit of a cop-out, so I will try to expand on that a bit more. I totally agree that service businesses are certainly taking a front and center. Tariffs have obviously been impactful. I've never heard the term domestic supply chain referred to so positively. It's like a deal plus, and who would have thought that was the case? But yeah, a lot more add-ons. I don't see as many new platforms. People are trying to maximize their returns. We can talk about continuation funds, and as these investment periods are getting past the original plan, I've seen a lot of refis. So I know we talked a little bit about independent sponsors before. You guys did a great job of talking about the pros. There are cons too. You know, we've seen some refinance this year where the SBIC funds had to step in, and they own the business now because the independent sponsor went away. And I've seen more than a few of those come to market, and they're trying to recap. So a lot more recaps, a lot more add-ons, not as many good platforms, and a lot of domestic supply chain or service businesses seem to be what's coming across my desk.
Yeah, and I think so. Sean, you're covering a lot of the demand side for acquisitions, talking a little bit about the supply side. You know, anecdotally, maybe there were a lot of retirements in 2021 that were quiet retirements because it was a function of people who may have left the workforce for COVID and never came back. One of the key themes in the past couple panels were people talking about founders have a business, they talk to their kids don't want to take it on. And because in 22, 23, 24, there were a lot of reasons for people to sit on the sidelines, that founders continue to age. And as founders continue to age, you're only kind of pushing off the inevitable. So there might be another event coming up in 26 that we're not expecting, that could be tariffs, could be, a war. I mean, who knows what that's going to be. But absent that reason not to sell coming, I think there's a lot of pent-up supply for folks that are still going to be looking for an exit, because baby boomers continue to age, and you continue to age regardless of what's going on with tariffs or Ukraine. So, a lot of what we've seen, a lot of conversations we've had are people who are interested in selling. And given that the interest rates, seem to be on a downward trajectory, that's going to increase the amount of powder that's available to buy. So, without knowing what the next big event is, I think that, there's a lot of potential for 26 to be a strong year. But then again, that's what we talked about going into 25, 24. So,
Yeah.
Who knows?
We will see. Kevin, thoughts, because you were kind of nodding as Sean was talking. Yeah.
Yeah, I'll add to that. I said before, nobody's cured aging yet. So these business owners have to do something, right? The rates are coming down, and I do believe that there is momentum there. People are getting comfortable with all the chaos in Washington, and they're trying to find ways around that. And they're convinced that chaos is going to be there for another 3 years. It's just not going to change the way this administration is doing business. So they're all trying to find ways to transact and make it work. I think the interest rate drops, the actual drop, and not just talking about it, is a great first step. I think it gave a lot of business owners some confidence on where it is. So I'm hopeful 26 is again agnostic to or aside from something happening that we don't know what it could be. 26 is primed for something. So and the private equity shops too. I mean, so.
Yeah, and I think that point on people getting comfortable with uncertainty is kind of the story for this year, right? Like Q1, Q2 felt pretty slow, but the transactions we were working on weren't dying. They weren't moving. And time kills deals. So, a certain portion of the market probably didn't move forward, but we've seen a lot more deal activity late, Q2 into Q3 because it was a lot of that backlog from earlier on this year where people who may have been sitting on the sidelines are saying, I don't know if I want to move forward with this. They said, you know what? This is the way of the world. We're going to move forward with it. And, it's been a busier second half of the year as a result.
Yeah, thank you. So, Mike, given that backdrop, can you talk to us about quality of deals that you're seeing?
Yeah. So I think in line with the fact that a lot of businesses held off from going to market, the companies that may have gone to market in the beginning half of the year were less exposed to tariffs, were good businesses, but there was just less companies going to market. I certainly think deal quality has picked up in the second half because there are a lot of good businesses that have sat on the sideline. And maybe it's just because we're seeing more deals. And because of that, the quantity of quality deals that we're seeing is just naturally increased. But there have been a lot of good businesses that were sitting on the sidelines. There's a little bit more certainty in the market. And now those companies are starting to come to market. And so I think in the second half of the year, we've certainly seen, just quality of deals pick up, which is always nice to see.
Oh, yeah, thank you. I'd like to dig a little deeper into. Oh, go ahead. Yeah.
How many of those deals are proprietary versus kind of a buying through a process? So when I was reflecting, looking at that chart about the growth of independent sponsor deals, one of the primary drivers, in my opinion, is independent sponsors were finding proprietary deals for these other capital sources. So that's what drove the activity because everyone thought they were getting a great deal that didn't come to market. I think independent sponsors are starting to have to go through processes now because they're sourcing less and independent proprietary deals. How has that mix changed for you? Are you guys?
Yeah, so I would say the comment on quality is mostly through banker-led processes or auction processes. So that's where we're starting to see the pickup. I think on some of the proprietary deals, those are more opportunistic. And so when you're targeting those, I would say it's more specialized situations where the quality that you're looking at is you're making more specific or concerted effort to find those businesses. And so I would say the quality there is a little bit more stable throughout the year.
Yeah, and Sean, that's kind of where I was going as well. And maybe this is a question for both of you. Anything different that you're seeing in terms of the capital stack, what those actually is looking like or trending toward?
Yeah, I think with the current interest rate environment that we're in, interest rates are expected to come down if you look at the forward yield curve. So I think people are getting more and more comfortable using a little bit more leverage. And although, a firm like Argosy, we're not the type of firm that really tries to use a ton of financial engineering. Other firms in the market are going to lean into financing more and more if interest rates do come down as they're expected to, which typically results in higher valuations, all else equal.
Yeah. Anything, Sean, you would add?
Yeah, I mean, my reference to private credit earlier. I mean, I think, the market's become more aggressive. I think some banks are sharpening their pencils because they're sick of losing to private credit. I think, as we've alluded already, as interest rates start to come down, senior plus mezz structures, the total cost of capital will maybe be a better kind of trade-off. But I'm interested to see what happens through whatever the next cycle or event that happens, and how these private credit lenders behave, and who winds up with the keys to that car after the cycle. But I'm optimistic that the falling interest rates will bring back more senior plus mezz structures as opposed to where private credit's been dominating recently.
If I could just add one thing really quickly. So in my prior role, I used to work at a private credit fund, and understanding what the kind of fee structures were at the time that I worked at that firm versus where private credit prices deals and what fees are being charged in the market today. It's a little bit staggering to see how fees have come down even from what I thought were relatively low levels a few years ago. So the market's definitely gotten a lot more competitive.
I also wanted to add in that deal structure is also changing a lot more. I mean, it's a couple years ago, it was almost like cash on the barrelhead, and now there's equity rollover, there's earnouts, there's structure back in these transactions to cope with the higher interest rates that are there, and change that and kind of fill that gap, that value gap that's there, and perceived value gap. So all that's coming into play right now again. So.
Yeah. Thank you. Jonathan, can you talk to us a little bit about deal mechanics? Like, what are you seeing in terms of diligence? I think as we kind of powwowed before this discussion, there's definitely some changing trends there in terms of timing and diligence required. Can you talk to us about that a little bit?
Yeah, that's right. So, like I said earlier, time kills deals, and that gives a buyer more of an opportunity to do a deep dive on a target, find potentially something that's going to be an issue. So when there's uncertainty in the market, that gives people more of an opportunity to do that due diligence. And a lot of what we saw earlier this year was people honing in on what might be a specific indemnity item. It wasn't we need to have gun to your head, get this deal done by such and such a date. That trend may be changing if in 2026 there's more competition with lower interest rates, better financing, more demand to get deals done. But when there isn't that demand, then you're gonna have more of an opportunity to dig in on particular diligence items. The other thing that I've really seen, and this is more of an ongoing trend of maybe the past decade, but the reps and warranties insurance market has really matured. I mean, 10 years ago, there were a lot of conversations with folks just getting their head around what is this product, how does it work? And then 5 years ago, the conversation may have been, well, we understand how this product works, but it only covers particular segments. Like, you're not going to get a financial services deals, you're not going to get a healthcare deal that's going to be insured by reps and warranties insurance. And then 4 years ago, the premiums really popped because of just the deal volume in 21. For the past 2-3 years, there really has been a stabilization with, premiums being at, maybe around a 3% as opposed to 6% of enterprise value. And so it's really become more of the norm than an exception to have a deal that's insured. And now, obviously you need to have the right price point. So deals below a certain dollar value are not going to be insured, but, there's really, that's just become part of the norm of the deal process.
You mentioned the time kills deals a few times now. So one of the things that I've been thinking about, we probably all remember the deal flurry that happened at the end of 2020 and into 21. And a lot of that was because the pause that happened during COVID and that uncertainty. So I think there is a possibility that, the asset people might have walked away from when, what is the pause? What's the day?
Liberation Day?
Liberation Day. Sorry. I wanted to say D-Day, but yeah, Liberation Day. So, the unknown that was around Liberation Day was similar in a lot of ways to the unknown around COVID. And now fast forward a couple quarters and you can see how that management team in the business survived and adapted. The strength of that management team might have, it might be a more appealing asset to invest, but now after you've seen them navigate through a difficult time like that. So that's my new optimistic take on what could happen at the end of this year. So if those businesses have survived and adapted, I think that might be a better investment story than you thought 6 months ago.
Yeah. I'd like to come back to something, Jonathan, you were talking about in terms of retirements driving some M&A activity. I think Shelby called it the silver tsunami, with the boomers aging out of their businesses. And we saw some really interesting data about New York State and this propensity to believe that they're going to pass these businesses on to the next generation. What are we really seeing? Can you talk about M&A activity across New York State, given the audience, particularly with boomers that are ready to transition?
Yeah, I was the stats we saw earlier were a bit surprising. I'd like to drill into that a little more because I wonder what the sample size was for folks in particular in New York, because I mean, the conversations around succession planning are happening all the time. And it seems like more deals than not involve a founder, or if not a founder, somebody who's been a key principal in the business who wants to get out, and son or daughter isn't getting involved and there isn't an obvious succession plan. So that's common refrain, and that's been the case around M&A for for as long as people have been selling businesses, but it feels particularly accelerated, and I don't know if that's any different in New York than anywhere else. Although, frankly, there are more folks. You're probably more likely in New York State to have a kid who may have moved somewhere else, or the founder who wants to move down to Florida. So if anything, I would think it would be more accelerated. Um, and the other piece is, for a lot of mom and pop shops, it can be hard to continue to comply with regulatory requirements. And New York State labor laws are constantly evolving and tend to be some of the more strenuous ones in the country. So that's a natural reason to be ratcheted onto a larger platform, because you're going to have somebody who's the HR professional who knows how to comply with, the New York State sexual harassment training and paternity leave laws that are changing on a routine basis.
I'll add to that. I'd say about a third of my pitches, again, I'm family founder owned, but I say a third of my pitches aren't really pitches. They're more educational, of talking about succession planning, what the options are for the owners, and really helping them educate them so they can make a good decision when the time is right. But more and more often, we're finding that the children aren't coming into the business, haven't even been involved, and they're now adults already, have never been involved in the business. So these owners are now thinking through, what are my options? What are my plans? Is it an ESOP? Is it my management team? Is it an equity? Is it a private equity? Is it strategic? Do I roll some over? I mean, I spend an inordinate amount of time with our network inside our clients at Rhythm, talking to the business owners about their different plans, the different options that they have. Many owners think their only option is to sell the business, but we really sit down and talk to them about what other options they have to do that. So my lead time is extraordinarily long because of that.
The education piece. Yeah, certainly.
Yeah.
Yeah, I mean, I would agree. Certainly, this is just anecdotal, but in our portfolio in Eastern New York, it far and away, the next generation is not as interested in the business. And I'm assuming you're seeing the same on this side of the state. So I just found that stat very interesting.
I think it's aspirational.
Yeah.
That number is very aspirational. It's not necessarily reality, but it's what they hope is going to happen, and really think it's what.
Yeah.
And one thing that we've been seeing, and this is more anecdotal than anything else, but Argosy invests in a lot of founder-owned companies. And most of the time, historically, we've been investing and buying the company directly from the founder. We've started to see one or two instances where maybe a child of the founder has taken over the business and then realized after a few years that they don't actually want to be involved in the company. They gave it a go and realized it wasn't for them. And so then the child is looking to sell, or the children. So you're maybe starting to see that second level come into play, and people may or may not want to be involved for the longer term.
Yeah, that makes sense. So, Mike, I want to come back to you because you mentioned something this morning in the workshop, and this has kind of permeated a lot of our discussions. Talk about the impact of AI and what we do and getting these transactions done. I mean, we could talk about it all day in terms of what all the different businesses do, but your firm's using AI in particular to make smart decisions and be more efficient. Can you explain that?
Yeah, sure. So for folks who weren't part of the panel earlier this morning, at Argosy, we have built out a in-house AI tool that we're using to help us evaluate companies and sift through data. So we have this tool that allows us to choose a variety of different language models. We can plug in our own in-house data within our shared drive and ask the system questions, have it put together analysis for us, and use it really as a tool to help streamline our analysis of a company or of data. And that's been really helpful. So if you could plug in a data room as you're going through diligence and ask questions, try to get intel on certain trends, and really short circuit the process that normally takes people hours of working in Excel or digging through subfolders upon subfolders. It just allows you to have faster insight to make better decisions in a faster manner. And I think more and more firms are going to start to shift to that model over time. And so diligence processes may accelerate because of that. But yeah, AI is something that is here. I think a lot of firms are starting to lean into it, and people are trying to find creative ways to use AI. At least today for our firm, we use it mostly on the front end on diligence, but this tool that we're continuing to build out will ultimately be used for portfolio management as well. And we're starting to kind of develop that skill set too.
And my question for you on that, so what safeguards have you put in for that, and how do you protect against, hallucinations when it's looking into the materials? Because I mean, from our perspective, law firms are in the process of getting into to AI now. Law, like everything else, is 2 steps behind. But there's a lot of concern over hallucinations, and you see the stories of the AI makes up a case that doesn't exist, that type of thing. So how do you protect against that?
Yeah, so that was one of the 2 things that we were concerned about when building out this tool. The first thing was just data security. We're working with a lot of confidential data, so building our own tool in-house allows us to, everything's kind of self-hosted, so no data is going out elsewhere outside of our 4 walls. And then from a data integrity perspective and making sure that the tool is not hallucinating, when the system produces results, it cites where it's getting all of its sources, so you could click in to the sub data, and that's a best practice. You should actually, dig in and make sure that the data that it's pulling is responsive to the question that you're asking and it is accurate.
Yeah, I was gonna say we're piloting a couple AI kind of solutions, different tools for different things, and that's exactly what we do. We everything gets footnoted when it's referenced in its findings, so we can dig back into and test back to where it found it there. But I think the AI is here to stay, and finding the right solution. I don't think it's gonna be one tool for everything. It's going to be multiple different AI tools to help develop whatever the process is or whatever we're looking to do. That's what we're leaning in investment banking.
And even on the operating company side, I think AI, I mean, I'm sure people have heard a lot about AI. I was just at a conference a couple of weeks ago where there was a lot of vendors demoing virtual customer service reps or folks that you could call into. And it's pretty astonishing. You could call into a company, talk with somebody, and if they don't disclose that it's AI, you would have no clue that you're not talking to a real person. So call centers, other areas where people are calling in on the phone looking for services. I think there's going to be a lot of disruption and efficiencies created by using software in that area.
Yeah, certainly. Thank you. Well, let's open it up for questions. If we have any questions from the floor for these guys.
Hi, it's still in the AI conversation. I encounter a lot of companies that aren't making the MRT systems to their full capacity. So do you find that you have a gap of either like extremes with your prospecting companies or your portfolios, or, I mean, just getting everybody in one ERP for accounting is usually a hurdle. So
Yeah, we invested in a company a year ago that is a rental business. They do temporary construction rentals, and when we invested in that business, I don't think there was a single electric company. It was crazy. Everything was on paper. Everything was on whiteboards, and within a year, they are doing automated quoting. They're leaning into technology and AI, and have gotten completely off of paper. Everything's now digital. I think there are extremes, but there's ways to adapt and invest and pivot yourself to a more digital footprint pretty quickly. And that business is seeing a lot of operating efficiencies from doing so.
President Sean, just keeping it with AI here a little bit. Would you speak to the most impactful use cases that you could see on the banking side?
I mean, I don't know if I have a great case, to be honest. I mean, I think data helps make better decisions. So I think the best case we can make is to improve our credit process, improve our data, and just make better decisions. But at the end of the day, my bankers are still players in the field, and they have to make the decisions when they're out there. So it's a tool. It's not the end all be all.
Yeah, we're working with one tool that's really helpful when we get ready to do a pitch. Right, we have to learn up and study up real hard on that industry, that niche, So there's that market research kind of tool that we have that we're developing that will help on that. And so it'll cut the time from developing a pitch book a week down to days. And that's kind of our goal. It's not to cut out what we've done, but it's to shrink the timeline that we're doing. And the other thing is, as we prep a company to get ready to go to market, we gather all this information, all their financials, right? All their financial models, the market research, the notes of the business, all that stuff. We put that basically into a virtual data room. And now we have an AI tool that we're piloting that will help synthesize all that and give us a rough draft of what a teaser will look like, or what a first draft of a sim will look like. And it's a great starting point, but it still is not the intuitive side of telling the story. You still have to take that, what it gives you, and think. So that creativity is always going to be there. And being able to develop and build that story, no model is going to do that. You really have to talk through it, because every industry, every niche is different from my perspective. And yeah, every sim talks about 6 or 7 or 8 different areas they have to talk about for that business. But within that segment, you have to create that story. So AI has been a great start to kind of shrink and take some time out of it, but it's never gonna be the end all be all, my opinion.
Yeah, these are relationship-based businesses at the end of the day. I think you need the AI and the data to be on a level playing field. But at the end of the day, it's still a person making a decision and trusting someone else.
It's just a very powerful search engine at the end of the day, right? And it's not going to write the narrative for you, but automating the finding of information is what we're seeing a lot.
It's funny you should say that. We're regulated by FINRA, right? So FINRA came in and asked me last week about what AI tools we're using and what we're doing, and I'm just like, we use Microsoft Copilot, and they go, that's nothing but a souped-up Google search, and that's how I put it to the FINRA regulator, and they're like, yeah, you're right. So.
My question is not AI related, so I just want to let you know. And it might require you guys to pontificate just a little bit. My question or comment is, are you able to talk a little bit about minority businesses and minority equity plays? And what I mean by that is, a lot of times the fundamentals that are normally used, the language that's normally used, aren't received or there's not a lot of muscle memory from those businesses because they're not focused on EBITDA or stuff like that. They might have just a different language. Are you guys able to identify those opportunities, given sometimes they come in a different package than some of the more traditional businesses might?
I gotta imagine that you would love to invest in a business that you could get at a good multiple because they're not properly telling the story.
Yeah, I think at the end of the day,
Sorry.
when we are, looking at a company to invest in, it comes down to that company's fundamentals and not just where a company is today, but where I think we could add value, grow the business. And so with the right partnership and the right people at the table, if we feel like there's an opportunity to help partner with that company, implement systems and processes and grow the business, that's the perfect opportunity for an investor like an Argosy or some of the other folks that participate in our world. So I think at the end of the day, that's primarily what it comes down to.
Yeah, it's all about positioning that story. And I keep using the word story again, because that's really what we tell. And so what I do in investment banking, right? We get the numbers, we get the facts, and we create a story for that. So it's doing their homework and being ready to articulate not where you've been, but where you're going as part of that. And that's a big part. So take the time, invest in prepping for that transaction, and then get your story down.
I would tell whoever that business is, though, to make sure they have the story told before the private equity guy underbids them.
And it's also a matter of finding the niche in the market, right? Because, when we do transactions and we're representing a, minority woman-owned business, you're in a different segment of the market, but, there's a very powerful story that can be told there. And there's, the players that are going to look for that might be a little different, but, it's an attribute of the business that if you find the right buyer, and you have a great opportunity for.
Hello. I think my question fits with Mike, I guess. I'm a founder of agentic AI company, and I would like to learn how do you distinguish an AI company if it is really proper AI company like our company. We founded it 5 years ago, iterated with 40 million hours of data, have our own codes, and so do you have that technical stuff and vision with you, or do you bend on any associates, professors in these kind of situations? What do you see?
Yeah, very good question. I mean, everyone attaches AI to their name these days, right? It's the thing that I think generates a lot of buzz and a lot of interest. I think really spending time with the software and demoing it and getting familiar with it is one part of the puzzle. The other piece of the equation is having the right partners and technical experts to evaluate a piece of software for you. And so that is something, at least with our firm internally, where we have third-party AI experts who are, I would say, it's what they do for a living is evaluate these, types of tools and this type of technology. And we partner with those people who can help validate way more than someone like myself could, whether or not that the tool that we're looking at has a real differentiation or is a real tool versus just something that someone slapped the word AI onto.
And can I have a follow-up question? And I don't know if it's that precise in your head, but do you have any percentage that you normally rely on ARRs and MRRs? And in AI case, what is the percentage? What is the difference? Because nowadays we see billions of dollars is being invested on OpenAI, for example, and there is no result right now. They're investing on their technical potential and ability, and lots of infrastructures will be following them. So can you make this kind of math?
In terms of which technology folks think might.
In terms of you rely on technology or financials, can you make these?
Yeah, I mean, I think in terms of technology versus financials, it's the technology should speak for itself when it comes to AI, right? Finding the right tools, and I think we're really at the forefront of this all, like you mentioned. I forget the numbers; they're staggering numbers, like you said, that are about to be invested in data centers, in some cases, starting up nuclear power plants and finding energy sources to power all of the AI that's on the forefront. So we're in the first inning. It still feels like as far as AI has come in the past 2 years. And so it's an evolving landscape where I think you need to be pretty nimble because there's no clear defined winner yet. Just like in the beginning of the, .com era, companies like AOL and Yahoo were the leaders, and look at where we are today in that perspective.
Thank you. Great answer. Thanks so much.
I got a quick question, not AI related, more about the silver tsunami related. So if you have all these older guys that are retiring, who do you expect will be the buyers? In other words, for your sample about a rental construction company, how do you find an operator who's going to know how to operate it day to day? Is it sort of a roll up strategy, or just kind of curious what you guys think the silver tsunami is going to look like on the buy side?
Yeah, I'm happy to take that one if folks would like. Yeah, so the silver tsunami is real. I think the stat I read recently was that there's 32 million people, which is a lot, employed by businesses that are owned by people who are 55 or older. And obviously, as the days go on, those people are going to head into retirement. That business that I mentioned, the rental business, that was actually a somewhat unique situation where it was a founder-owned business. We acquired the majority stake in the company, but actually backed the founder's son to be the CEO, and that's gone really well so far. So I think that there's a way for private equity to be involved while still having, the family stay involved in the company. So I think private equity will be a big part of it. I think you will see a lot of consolidation of some of these founder-owned businesses. I think roll-ups will continue to occur, and we are seeing in certain industries that are more heavily founder-oriented, smaller market sizes where roll-ups are starting to happen, and that is the path for a lot of founder-owned businesses where they're starting to head into retirement.
And I'll add, there isn't a playbook for every retiring business owner. I mean, there are going to be strategics, there are going to be roll-ups, there's going to be private equity, there's going to be management buyouts when the management team buys it from them and they take back a note and roll over. So there isn't. I don't see any one solution for the silver tsunami. It's just going to be exploring their options, like I said before, all the education, all the options that we're rolling out and talking to the business owners about. So lean on their advisors, I think, is what's going to end up happening.
At the end of the day, when someone's making an investment, they're going to be investing in the management team that's carrying forward. So even if that person's retiring, there's likely someone that's running the business, or if that business is going to trade and someone's actually going to buy it, they're going to have that person identified that could actually run it. Because if the owner operator is the business, it's not going to sell. No one's going to buy it.
Yeah. No, that's right. Although I do think, I mean, frankly, you see this across the labor market. There are shortages all across the board, and whether it be, in the HVAC space, and and like for the folks in the trades, the story is that nobody goes to trade school, and now trade school's got a lot more positive press in the past 5 years, but there still is just that labor shortfall. But it isn't only there. It's also, you talk to accountants, they talk about the shortage of accountants. Even among lawyers, there are too many lawyers, but the demand for lawyers, the associate level is definitely increasing. So I think it's across the board, but I think particularly in the bricks and mortar, the trade space, that's really where you have a lot of folks that maybe a founder, but they sent their kids off to school, didn't go to trade school, now they don't want to pick it up. And that's a common story that we see. So I think you might be more likely to see professionalization coming into those, as opposed to, your accounting firm that, maybe being acquired by a bigger platform, but has a lot of people still involved. But it's all across the board.
I'll also add, I've seen a kind of an uptick recently in professional management teams kind of running the businesses, where the owners kind of retire, go to Florida, and they hire a management team, give them some equity, and they become like the board and have like a family office almost running that business. So that's, again, another thing that's starting to happen out there as well.
Hi. Sorry about that. Another trend, not AI, that I've observed lately among larger companies, and there was an article in the New York Times about this a couple weeks ago with regard to Disney, is in pricing and moving, and companies looking to extract more consumer surplus from wealthier customers rather than seeking profit from selling more widely into the middle and other classes. Is that anything that you've observed in terms of that shift in pricing model among your companies you own or targets, or your clients? Give it in the middle market space, I guess, or elsewhere.
So I don't have a great answer. We don't do a ton of kind of consumer focused stuff. Most of our non-manufacturing companies are more B2B type of services. So we're mostly selling a lot of our products and services to businesses. I don't know if
I don't know if I have a great answer either. There was a Wall Street Journal article a couple months ago that I always reference. Consumer spending in the country, like, people think it's flat, but if you bifurcate it, I think this is what you're getting at. Like, the top 10% of spenders are spending a disproportionate amount of the total pie, and maybe the bottom 90% are spending a lot less. So I don't have a instance in my head of someone targeting that upper segment, but we're a consumer-driven economy. If we're going to sustain the level of consumer spending we have, it feels like it's inevitably going to be focused on that group, but I don't have a better answer than that.
Yeah, I have nothing to add on that.
No, I would say, if anything, I hear the opposite more often, that folks are looking for a steady, non-cyclical revenue stream, which is not going to be that, you're going to buy into the Disney, Star Wars hotel for a weekend. It's more targeting that HVAC, constant, non-elastic demand.
Well, what a way to end the day. That was incredible, engaging. Let's give them a round of applause. I just want to say a big thank you to our speakers, our sponsors, our attendees for making today such a success. I personally think it was. I hope you've made new connections, learned something valuable, and feel inspired about the future of private equity and M&A here in upstate New York. Please join us for the closing reception right outside the door. It's happening right outside. It's a great chance to relax and continue these conversations. At 6:30, we just have a little women's meetup exercise in the bar. And as you might see here, we do have a very informal after hours downstairs at Vault 237 right after 7 p.m. after this wraps up. Just want to make sure that, you can continue to follow each other through the evening. But I also, before I stop, I want to give one last incredible thank you to our event sponsors, Hamilton Lane, Hardesty Creston Emery, Colgan Law, Talent Rise, Argosy Private Equity, Blue Henge Capital, Western New York Impact Investment Fund, Pine Street Capital Partners, Lippis Mathias LLP, and also our major annual sponsors, Woods Oviatt Gilman, KeyBank, Witham, SUNY Research Foundation, New York Ventures, Hamilton Lane, Schwartz Hesling Group, and Hardesty Creston Emery. Thank you so much, and please enjoy the reception.